The Intelligent Investor by Benjamin Graham. This was the mentor for Warren Buffett, and I read the whole thing. It's like 600 pages, roughly a little less than 600 pages. And to be honest, it was very educational, but there was two major takeaways. The number one being tangible book. Tangible book is when you look at all the cash, the accounts receivable, the inventory, the property and equipment, all their liquid like accounts. If you look at the tangible book value of a company, and then if you compare that to the stock price or the market cap, when those are dislocated, when the stock is trading below the tangible book, that's how Warren Buffett made his money. He would find companies so cheap that the stock price was below all the accounts on the books, all the liquid ones. So there was actually more value, but when Warren Buffett would find tangible book higher than the stock price, he would buy it. And he would do 1 to 2 years holding period, and he would make, if it would double, then he would make double. But from what I understand, he would make like 50% return on that strategy alone until he changed it. He changed it later with Charlie Munger, and he just bought wonderful companies at a great price. But that's number one, tangible book value per share. And then there's actually a formula in here. Like this is the oldest source that I have found. It's basically Peter Lynch's formula, but you take the growth rate and you multiply it times 2, and that's what you can expect a good company to grow over a long period of time. So, but this is all the second concept. The second concept is earnings yield. When you know a company is going to grow at 15%, you don't want to pay that, but you want to know it's worth that. And then what they would do is they would try to pay the lowest PE possible, which means they would get the highest earnings yield. A good example is like Apple stock. Berkshire bought Apple stock, and it was, I believe they paid like 10 times cash flow, and they knew it was a quality company. It was growing at 20%, but they paid like a 10 PE or 10 price to cash flow, and it quadrupled. So that's the example for earnings yield. Tangible book and earnings yield, keeping in mind the growth rate. This is a quick summary. I hope you found it useful. If you did like it or have any questions, go ahead and make a comment. Cheers.